Hi everybody, and welcome back to video number 3 in chapter 17. When we left off, we were looking at revenue constraints. Now, on January 1, the Shira company enters into a contract with He-Man Incorporated to perform asset management services for a year. Shira receives a quarterly management fee based on a percentage of He-Man's assets under management at the end of each quarter. In addition, Shira receives a performance-based incentive fee of 20% of the fund's return in excess of the return of an observable index at the end of the year. Shira accounts for the contract as a single performance obligation to perform investment management services for 1 year because the services are interdependent and interrelated. To recognize revenue for satisfying the performance obligation over time, Shira selects an output method of measuring progress towards complete satisfaction of the performance obligation. Shira has had a number of these types of contracts with customers in the past. So, at what point should Shira recognize the management fee and the performance-based incentive fee related to He-Man? Well, Shira should record the management fee each quarter as it performs the management of the fund. However, Shira should not record the incentive fee until the end of the year. Although Shira has experience with similar contracts, that experience is not predictive of the outcome of the current contract because of the amount of consideration is highly susceptible to the volatility of the market. In addition, the incentive fee has a large number and high variability of possible consideration amounts. Therefore, revenue related to the incentive fee is constrained and not recognized until the incentive fee is known at the end of the year. Okay, time value of money. When a contract sales transaction involves significant financing component, number one, interest is accrued on consideration to be paid over time. 2, fair value determined by discounting the payment using an inputted interest rate. And 3, the company reports as interest expense or interest revenue. Let's take a look at an example. Here, on July 1, 2025, SEK Company sold goods to Grant Company worth $900,000 in exchange for a 4-year, zero interest-bearing note with a face amount of $1,416,163. The goods have an inventory cost on SEK's books of $590,000. SEK uses the perpetual inventory method. Questions. Alpha, how much revenue should SEK Company record on July 1, 2025? And Bravo, how much revenue should it report related to this transaction on December 31, 2025? So if we look to the solution, alpha here, SEK should record revenue of $900,000 on July 1, 2025, which is the fair value of the inventory in this case. And then Bravo, SEK is also financing this purchase and records interest revenue on the note over the 4-year period. In this case, the interest rate is imputed and it is determined to be 12%. SEK records interest revenue of $54,000 times 12% times 6/12 times 900,000 to get that $54,000 at December 31, 2025. So now if I look at the present value of that, I'm going to look at taking 900,000, and that is the 900,000 given in the problem, divided by the face value of the note, and that would suggest that that's 0.6355. And if we interpolate a little bit using the present value of an amount for 4 periods, the implicit interest rate is 12%. So you'll have to go into the present value tables and look for this 0.6355 in 4 periods. And that will back you into the interest rate of 12%. Okay, so then to record the sale on July 1, 2025, we'll debit notes receivable for $1,416,163 and credit discount on notes receivable of $516,163 and credit sales revenue for $900,000. And at the same time, we'll also reflect the cost of goods sold and inventory as a debit and credit of $590,000. Now, to record or accrue the interest revenue at the end of the year, we'll take the discount on the notes receivable, $54,000, and the interest revenue of $54,000. The $54,000 again is 12% times 6/12 times 900,000. Okay, a little involved, but I think you follow the logic. Okay, companies, for non-cash consideration, companies may receive 1, contributions, for example, donations and gifts, or 2, contributions of goods or services from customers, such as equipment or labor, as consideration for goods provided or goods performed. Companies generally recognize revenue on the basis of the fair value of what is received. Now, if the consideration is paid or payable to customers, then 1, that may include discounts, volume rebates, coupons, free products, or services. And 2, in general, these elements reduce the consideration received and the revenue to be recognized. All right, here's a volume discount example. Here, Samsung Company offers its customers a 3% volume discount if they purchase at least 2 million of its product during the calendar year. On March 31st, 2025, Samsung has made sales of 700,000 to Acctg Company in the previous 2 years. Samsung sold over 3 million to Acctg in the period April 1 to December 31st. So we're going to assume that Samsung prepares its financial statements quarterly. So the question is, how much revenue should Samsung recognize for the first 3 months of 2025? And in this case, Samsung should reduce its revenue by $21,000. The $700,000 that it made in the first 3 months times the 3% volume discount, because it is probable that it will provide this rebate. Revenue is therefore $679,000, representing $700,000 minus $21,000. To not recognize this volume discount overstates Samsung's revenue for the first 3 months of 2025. In other words, the appropriate revenue to be recognized is $679,000, not $700,000. So given these facts, Samsung's going to make the following journal entry on March 31st, 2025 to recognize revenue. Debit accounts receivable, $679,000. Credit sales revenue, $679,000. Now, assuming that Samsung's customer meets the discount threshold, Samsung makes the following entry to record the collection of the accounts receivable, and it would debit cash and credit accounts receivable for $679,000. If Samsung's customer fails to meet the discount threshold, then Samsung makes the following entry to record the collection of accounts receivable. It'll debit cash for $700,000, credit accounts receivable for $679,000, and credit sales discounts forfeited or sales volume discounts forfeited. As indicated in Chapter 6, sales discount forfeited is reported in other revenues and gains section in the income statement. Okay, so if we look at the bit of a summary here, our variable consideration and the constraint, the company is going to estimate the amount of variable consideration to which it expects to be entitled by giving consideration to the risk of the revenue reversal in making the estimate, and that becomes the transaction price. In a non-cash consideration, that's going to be measured at fair value, if that can be reasonably estimated. Otherwise, a company uses a standalone selling price of the good or service that was promised in exchange for the non-cash consideration. If it's a significant financing component, for contracts with a significant financing component, a company adjusts the promised amount of the consideration to reflect the time value of money. And then lastly, if the consideration payable to a customer, a company needs to determine whether the consideration payable to a customer represents reduction of the transaction price, a payment for distinct good or service, or a combination of the two. Okay, allocating the transaction price to separate performance obligation. Step 4. 1, we're going to normally base it on relative fair values. Number 2, it's the best measurement of fair value is what the company could sell the good or services for on a standalone basis. However, 3, if not available, the company should use their best estimate of what the good or service might sell for as a standalone unit. Okay, allocation approach, the adjusted market assessment approach. Here, we evaluate the market in which the company sells goods or services and estimates the price that customers in that market are willing to pay for those goods or services. That approach might also include referring to prices from the company's competitors for similar goods or services, or even adjusting those prices as necessary to reflect the company's costs and margins. And the expected cost plus margin approach, that forecast is based on the cost of satisfying performance obligation, and then we add an appropriate margin on top of that for goods or service. And then the residual approach, if the standalone selling price of a good or service is highly variable or uncertain, then the company may estimate the standalone selling price by reference to the total transaction price less the sum or observable standalone selling price or other goods and services promised in the contract. This looks like a good place to stop this video, and when we return, we'll take a look at the transaction allocation example. And